As if monetary policy decisions from the Bank of England and the European Central Bank were not enough, the coming week will also feature a meeting of OPEC Plus and the latest batch of jobs, wage and unemployment data from the USA. The news flow will come thick and fast from the bottom up too, with long lists of scheduled results in the USA, Europe and also the UK, where 1/6 of the FTSE 100 index and its members will publish numbers, with a few mid and small cap companies joining the fray. In London, the diary looks to be as follows, pending any last minute changes. Monia Group on Monday the 23rd, Standard Chartered, Croda, United, McBride on the 24th. Haleon, Hiscox, Convatec, Shaftesbury Capital, Morgan Sindall, Hammerson, Aston Martin, Lagonda and Aving Trans on the 25th. Rolls-Royce, London Stock Exchange, Howden Joinery, Hikma Pharmaceuticals, WPP, Drax, Genus, Derwent London, Ocado, Tate & Lyle and Vanquis Banking on the 26th. And International and Consolidated Airlines, Melrose Industries, Pearson, Rightmove, Tritax, Big Box Hayes and Just Group on Friday the 27th. But even allowing for that high-powered list, 3 other names may just write the most headlines, and they're NVIDIA in the USA and HSBC and Diageo here in the UK. All 3 report on Wednesday the 25th. Now NVIDIA may need little introduction. It's the world's largest company by stock market capitalisation at some $4.4 trillion, thanks in the main to its dominant position in the field of graphics processing units or GPUs, silicon chips that are used to power artificial intelligence or AI training, inference and large language models. The launch of OpenAI's ChatGPT chatbot in November 2022 has fired NVIDIA's sales, profits and share price. But they set a 4th quarter and full year results for the 3 and 12-month periods to January 2026, well they come at an important time. NVIDIA's shares have gone nowhere fast since last summer. That's despite the huge increases in spending on AI infrastructure such as data centers, servers and chipsets announced by the so-called hyperscalers. Their guidance for 2026 points to a further increase in capex of more than 50%, after jumps of 76% in 2025 and 60% the year before that. This bonanza should feed through to another strong set of results from NVIDIA, which has the uncanny knack of beating analysts' forecasts, either owing to careful management of expectations, strong trading, or a combination of the two. Based on the guidance given by Chief Executive Jensen Huang alongside the 3rd quarter results, analysts expect the following for the 4th and final period. Sales growth of 67% to $65.5 billion, and a 71% jump in earnings per share or EPS to $1.52. Even more important may be any guidance for the first 3 months of the financial year to January 2027, where the current headline consensus forecasts are sales growth of 56% to $68.9 billion and a near doubling in earnings per share to $1.60. Remember that in the 1st quarter a year ago, NVIDIA took a $4.5 billion write-down owing to US export restrictions on its products to China. Such momentum begs the question of why NVIDIA's shares may be becalmed. It could be that shortages and blockages in the supply chain mean it's harder for the company to provide the upside earnings surprise the market craves. It could be doubts over whether the hyperscalers can keep spending at their current rate. And it could be doubts over how customers like OpenAI and CoreWeave are funding their GPU purchases. NVIDIA's inventory and trade receivables have grown faster than sales in each of the last 4 quarters. Equally, it could just come down to valuation. NVIDIA still trades in around 25 times forward earnings, a premium to the wider US market. Rather like those of NVIDIA, shares in HSBC have slightly run out of puff after a very strong run, possibly slowed down by both high valuations and also the absence of fresh share buybacks from the megabank until the second half of this year, following on from the $13.6 billion purchase of the 37% stake in Hong Kong's Hang Seng Bank it didn't already own. Analysts still expect good results all the same. They'll watch out for trends in the following to see how they drive 2025's results and how they could shape those for 2026, namely loan and deposit growth, net interest margin, loan and asset impairments, and the cost-to-income ratio. In terms of the headlines, the consensus estimates are pre-tax profit of $28.9 billion in 2025 and $35 billion in 26 against $32.3 billion in 24. Earnings per share of $1.16 for the year just ended and $1.55 for the year just begun against $1.25 in 2024, and ordinary dividends per share of 72 cents in 25, 78 in 26 after 66 cents in 24. And finally we come to Diageo, where the drink shares are finally showing a bit more spirit after a terrible run. Input cost pressures, worries over changing in drinking habits across generations, tariffs and the possible impact on demand of GLP-1 weight loss drugs have all hurt the shares, as have weak operational performance in the absence of any really major shake-up in the corporate structure, although with big cost-cutting programmes in place. For the first half results to December, analysts expect a 3% drop in organic sales for a headline revenue figure of $10.5 billion and a 4% drop in organic profits for a pre-tax income of $2.7 billion. An unchanged first half dividend of 40.5 cents a share is also expected. Even more important may be any review of guidance for the full year to June, where analyst faith seems to be wavering a bit. The company has previously steered estimates towards flat to down organic sales growth and low to mid-single digit percentage growth in organic profit. I hope that you and your families are all keeping well. Thank you for watching, and I look forward to seeing you again next time.